What led to the downfall of one of America's biggest companies? That's the question we'll be unraveling today as we delve into the enigma of Enron. Once upon a time, Enron was more than just a company. It was a powerhouse in the energy sector, a titan with global reach and influence. Its operations were vast, its profits astronomical, and its name synonymous with success. Enron was the epitome of American corporate prowess, a shining beacon of prosperity in the world of business. But then, in a shocking turn of events, this energy giant filed for bankruptcy. The news sent tremors through the global business community, leaving many to wonder how a company of such magnitude could fall so dramatically. So, how did a behemoth like Enron crumble to dust? Stay tuned as we unravel the mystery piece by piece in this captivating tale of ambition, power, and downfall. Enron's story starts in the 1980s, a tale of rapid growth and innovation. Born out of a merger between two natural gas companies, Houston Natural Gas and Internorth, Enron was a new breed of energy company. It was driven by an audacious vision to transform the energy market, and it did just that. Enron's most significant innovation was its energy trading platform. Imagine the stock market, but instead of buying and selling shares, traders were dealing in energy futures. This was a game changer. For the first time in history, energy became a commodity that could be traded just like stocks and bonds. This new business model was not just unique, it was revolutionary. Enron's success didn't stop there. The company expanded into other sectors too, such as water utilities and broadband services. It was a high-flying corporate titan, consistently outperforming market expectations. Year after year, Enron was delivering excellent results and investors couldn't get enough. The company's rise to prominence was nothing short of meteoric. In just over a decade, Enron went from being a mid-sized energy company to one of the biggest corporations in America. By the end of the 90s, Enron was the seventh largest company in the United States, boasting revenues of over $100 billion. This success story didn't just turn heads, it won hearts. Enron commanded an immense level of trust in the market. Its stock was a favorite among investors, its bonds were highly rated, and its leadership was lauded for their vision and innovation. The company was a shining beacon of corporate America, symbolizing the limitless possibilities of the free market. But as we all know, every story has two sides, and Enron's story was no different. Behind the glossy exterior of stellar performance and groundbreaking innovation, something was amiss. With its innovative strategies, Enron seemed unstoppable. Or was it? The turn of the millennium brought with it a series of events that would shake the foundations of Enron. As the new millennium dawned, a series of accounting scandals began to surface, casting a long, ominous shadow over the once mighty energy titan. The first blow came in the form of allegations of creative accounting. Enron was accused of using complex and often misleading financial structures to hide losses and inflate profits. This made the company appear much more profitable than it actually was. But as the saying goes, you can only juggle so many balls before they start to drop. Enter Arthur Andersen, Enron's auditing firm, whose role in this saga cannot be overstated. Rather than raising red flags about Enron's dubious accounting practices, they helped to facilitate them. In essence, they were the ones juggling the balls while Enron danced in the spotlight. The truth, however, has a way of coming out. Whispers of accounting irregularities turned into loud accusations, and soon, the U.S. Securities and Exchange Commission launched a formal investigation into Enron's financial practices. The result? A plummeting stock price that sent shockwaves through Wall Street and beyond. By the end of 2001, Enron had filed for bankruptcy. The seventh largest corporation in the United States, a company that had once been valued at nearly $70 billion, was now worth less than $1 billion. It was a fall from grace unlike any other in corporate history. The impact on employees and investors was devastating. Thousands lost their jobs, their retirement savings, their trust in the system. Investors, who had once seen Enron as a golden goose, were left with nothing but worthless stock certificates. In the end, the mighty Enron was no more, a victim of its own hubris and dishonesty. It was a sobering reminder that even the most powerful can fall, and that transparency and honesty in business are not just virtues, but necessities. The Enron saga is a cautionary tale that resonates till today. It's a stark reminder of the critical importance of corporate governance, transparency, and accountability in the business world. When these pillars are ignored or manipulated, the consequences can be dire, as they were for Enron. Enron's downfall led to a seismic shift in regulations and auditing practices. The Sarbanes-Oxley Act, for instance, was passed in 2002 in direct response to the Enron scandal. This act strengthened the role of external auditors, increased penalties for fraudulent financial activity, and set new standards for corporate governance. Moreover, the Enron debacle underscores the significance of ethical leadership. It's a lesson that power should never be allowed to corrupt, and that a culture of honesty and integrity should be fostered at all levels of a corporation. While the Enron story ended in tragedy, it left behind valuable lessons in its wake, serving as a reminder that integrity and honesty are the cornerstones of any successful business.